This is Nightly Business Report with Bill Griffith and Sue Herrera.
Better late than never. Santa finally shows up on Wall Street and in a big way. Stocks had one of their best days in a decade. The question is, can investors breathe easy now? And money moves. With volatility back, some expert advice on what you need to do with your portfolio as the new year approaches. All that and more for this Nightly Business Report tonight. It's Wednesday, December the 26th. And we do bid you a good evening, everybody, and welcome. Sue has the night off. Well, that was certainly interesting. Following the worst Christmas Eve ever for the Dow and the S&P 500 on Monday, stocks staged a powerful rebound today and made this the best day after Christmas ever. In fact, it was an all-time record day with the Dow posting its biggest one-day point gain ever and the best day for stocks in nearly a decade. Here are the final numbers. The Dow surged by 1,086 points, or 5%, to close at 22,878. The Nasdaq jumped nearly 6%, or 361 points, and the S&P 500 rose 116. That was good for a 5% gain. One more stat for you. Today's percentage gains were the best for the major indexes since March of 2009. Bob Pisani has more on today's rally.
Stocks staged an impressive rebound on this day after Christmas. In fact, it was the best post-Christmas rally for the Dow and the S&P in 45 years. The Dow surging more than 1,000 points, closing right around the highs for the day, the best showing since March 2009. Tech-heavy Nasdaq, best post-Christmas rally ever, helped by the FANG names, Facebook, Apple, Amazon, and Google parent company Alphabet. All were up 6 to 9% apiece, believe it or not. The markets got an early lift from comments from Council of Economic Advisors Chairman Kevin Hassett, who told NBC News that despite President Trump's harsh criticism of Federal Reserve Chair Jay Powell, Powell's job was 100% safe. Elsewhere, retail stocks like Macy's and Ross Stores were also sharply in the green after a very strong holiday shopping season. Now, keep in mind, the Dow and the S&P 500 are still on pace for their worst December losses since the Great Depression. There wasn't a lot of volume behind this buying today. It signals, to me, more seller exhaustion than buying enthusiasm. Regardless, it might be tough to call a market bottom just yet, but it's a good start. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Well, it was also a big day in the oil pits, where domestic crude had its best day in 2 years. The U.S. benchmark WTI closed up nearly 9%, back above $46 a barrel. And that surge helped push energy stocks higher. ExxonMobil, Chevron, Marathon Oil, and Hess were among the big names leading that group higher today. But despite the surge, oil prices are still more than 40% below their most recent high back on October 3rd. And as Bob Pisani mentioned earlier, Fed Chairman Jerome Powell got a vote of confidence from the White House today, and that added to some of the day's bullish sentiment on Wall Street. But as Steve Leisman tells us now, the president's issues with the Fed may actually go beyond its chairman.
The president's top economic advisor affirming to reporters Wednesday the president does not intend to fire Federal Reserve Chairman Jerome Powell.
Is the Fed chairman's job safe?
Yes, of course, 100%, yes.
100%. The Fed chairman's job is not in jeopardy by this president?
Absolutely, that's correct, yes.
Questions arose after numerous weekend reports that President Trump, angry at the Fed for raising interest rates, had been asking advisors if he has the power to fire Federal Reserve Chairman Jerome Powell. Trump nominated Powell to the post in 2017. On Christmas Day, the president continued his battle with the Fed, though perhaps softened his attacks up a bit.
I certainly have confidence, but I think it'll straighten. They're raising interest rates too fast because they think the economy is so good. But I think that they will get it pretty soon.
The president's criticism of Powell and reports of potential firing have been among the factors underpinning the recent market sell-off. Add to that overall instability in the president's administration, a trade war, a government shutdown, and fears of a Fed that will raise rates too much in the face of a weakening economy. One problem for President Trump is that his problem is technically not just with Fed Chairman Jerome Powell. Of the 5 members of the Federal Reserve's Board of Governors, 4 were nominated by President Trump and all approved by the Senate. All voted for the rate hike in December. Perhaps comments from CEA Chair Hassett and the president's own remarks mark the beginning of a truce between the administration and the Fed. If so, of the many worries behind the recent sell-off, markets can at least cross one off their list. For Nightly Business Report, I'm Steve Leisman.
And on day 5 of the partial government shutdown, the president is doubling down. He said today that he's ready to wait it out, and the shutdown could impact some of the economic data that Wall Street relies on. Ilan Mui takes a look at that part.
The government shutdown could last all the way into the new year. President Trump spoke to reporters while making a surprise visit to the troops in Iraq, where he doubled down on his pledge that he made on Christmas Day. He said no money for the border wall, no government spending bill.
How long do you think the shutdown will last, Mr. President?
Whatever it takes. I mean, we're going to have a wall. We're going to have safety. We need safety for our country.
This is a partial shutdown. It affects about 25% of the government. About 800,000 federal workers aren't getting a paycheck right now, and about half of them still have to show up for work anyway. The shutdown will have an impact on when some of Wall Street's favorite data points are released. New home sales and a report on international trade and retail won't be released this week. Data on construction spending set to come out next week could also be affected. However, the Labor Department is not part of the shutdown. That means the jobs report is still on for January 4th. Presumptive House Speaker Nancy Pelosi says she will hold a vote on a bill to reopen the government once Democrats take control of the lower chamber next week. But the Senate would still have to pass it, and the president would still have to sign it. So for now, the impasse continues. For Nightly Business Report, I'm Ilan Mui in Washington.
Certainly, there has been no shortage of volatility in the markets this month. I mean, that's for sure. The question is, who or what is to blame for all of the dramatic market swings, human or machine? Today, the Wall Street Journal, in this article, said that computerized trading is playing a growing role in that volatility. And joining us tonight to talk about it is Greg Zuckerman. He's one of the co-authors of that article. And also with us is Kenny Polcari, who spent more than 30 years on the floor of the New York Stock Exchange. He's one of those humans. He's now managing principal at Butcher Joseph Asset Management. Good to see you both. Thanks for joining us tonight.
Good seeing you.
Hey, Greg, certainly the volatility has increased. By some estimates, 85% of all stock trading is now done by computers or, in some variation like that. Some people think that's a good thing. Some people think that's a bad thing. What your article seemed to be suggesting, though, is it's simply just a thing, right?
Very good. Too many people have sort of misinterpreted our piece to be bashing the quants. One can argue that they play an important role. They trade frequently, they give liquidity to the market, but they also add a certain level of volatility. To me, I would argue that that there are trends in the market, fundamental trends, and they accentuate them. So they make things a little bit, push things in one direction. It could be up like in the last few years, and it could be down as well. So you don't want to point the finger necessarily at the quants and at these algos, as they call them,
right,
but they are responsible for some of the volatility going on out there.
Kenny, I read your Twitter feed. As I said, you're one of those humans. You spent all that time on the trading floor. You're not a big fan of computerized trading. Why?
Well, look, today's a perfect example. They closed the market up 1,000, almost 1,100 points on the Dow. That wasn't just the humans going in there buying. It was all driven by algorithms and high frequency. But look, I get it. Technology's here to stay. I'm not bashing the computers, but what I'm trying to say is, to Greg's point, it amplifies the moves. The momentum guys jump on, and then the algos are pre-programmed with a set of input data that they have to respond to. So as the market moves higher, the algos get more aggressive. The sell side sees it happening, so the sell side cancels inline offers and moves the offers up higher, and it forces the algos to reach and reach and reach. And you get a day like today where the market's up 1,100 points on the Dow.
Now, Greg, I know one thing that Kenny has, a point he's made repeatedly on Twitter is that these need to be regulated more. Is the SEC up on all this computerized trading?
I don't think anyone is. I think things have changed dramatically in the last few years, just over the course of the last few years. That said, I don't think anyone was calling for regulation of the markets over the last 5-6 years when quants, quite frankly, became the kings of Wall Street. You don't no longer have the sort of Peter Lynch's whose wife comes home and likes certain brand of hosiery, and then he goes and buys the stock, which is what he did with legs and made a fortune.
Right.
You've got these quants that have pushed up the market for many years, and now, to some extent, are pushing things down.
But Greg, that's exactly the point, right? That's exactly the point, is that you've got these computers making these decisions based on a set of input data without really understanding, what the word means. What does the intonation mean? What does the sentence really mean? These smart logics read the sentences, they pick out words that are either positive or negative, and then they create this action, either buy orders or sell orders, and it accentuates and amplifies the moves, which is then it takes the common, the average investor, the retail investor, the American out there that's sitting there scratching their head going, how does this happen? And it gives them a sense of concern, right? They're concerned about how can the market do this? How can we have these moves like this?
Okay.
Look, in the last week, we were down 1,500 points in 3 days.
See, I would disagree there. I don't think there are that many investors doing that, as you say, kind of seeing a word and trading on it. A lot of these programs, these models, are really doing what the old-fashioned investors used to do, buy, let's say, a low PE stock and selling a high one, those kinds of things.
Okay.
All kinds of inputs.
I agree with you, but do you think the market up 1,100 points today, or down 600 points on the day before Christmas, or 500 points on the Thursday before is a normal market move? The human beings never move the market like that, and I'm not saying what the computer's doing are wrong. What I'm saying is it's the amplification of the move, and it's certainly when the market goes up, everybody's patting themselves on the back, going, "Look how great I am." When the market goes down, they're all having a nervous breakdown. And look, I'm in this business, and people ask me all weekend, "Oh my God, what do I do? What do I do? What do I do?" You have to try to calm them down.
Last word, Greg.
I don't disagree. It amplifies things, but let's remember there have been panics since the Buttonwood tree trading started there. 87 was all kind of man-made. You could argue there were some models there, too. So there you go. And we got crushed and things swooned for no real good economic reasons in 87. So I don't think we can kind of look back the good old days when guys were on the floor and things were that much better.
I got to go, Kenny. I know you want to keep the conversation going, but I'm out of time at this point. But I feel like I've been sitting around the Christmas dinner table tonight, that's for sure. Kenny Polcari with Butcher Joseph Asset Management, Greg Zuckerman with the Wall Street Journal. Thank you both tonight.
Great seeing you.
Bye.
One piece of housing data out today. Home price growth was flat in October. The so-called S&P Core Logic Case-Shiller Index, which measures home prices in major markets across the country, rose 5.5% year over year in October, and that was unchanged from the September reading, by the way. The slowdown in price growth, though, is actually seen as a positive for home buyers. We have a follow-up now on a story that we first reported on several years ago. The former chief executive of Insys Therapeutics has now agreed to plead guilty to taking part in a kickback scheme to bribe doctors who prescribed its powerful opioid medication. Prosecutors say that Michael Babich, who resigned as the drug maker's CEO back in 2015, he was scheduled to go on trial next month, but instead he's now agreed to plead guilty to conspiracy and mail fraud charges. Coming up, the next wave.
It's the day after Christmas, and for a lot of shoppers, that means hitting the mall. Billions of dollars are expected to be spent today on December 26th. It's expected to be one of the 10 biggest shopping days of the year. Spending gift cards, returning those unwanted gifts from Christmas, we're going to talk all about it when Nightly Business Report returns.
MasterCard's Spending Pulse says that retail sales, excluding autos, topped 5% between November 1st and Christmas Eve. FedEx and UPS had already said that they expected record volume this holiday season. And today we found out how the major shippers did. Frank Holland has the shipping scorecard.
The week before Christmas is essentially the Super Bowl for the three major shippers. And today we have the holiday delivery report card. Grades are given based on on-time delivery. The post office getting the highest marks at 99%, with UPS and FedEx really just behind. Anything above 95% is considered excellent. Overall, the shippers saw their best on-time rates since 2013. They also saw a record amount of e-commerce deliveries, 2.5 billion total. This year, there were 32 days between Thanksgiving and Christmas, the highest number of days possible. And during the lead up to Christmas, including Thanksgiving week, Black Friday and Cyber Monday, UPS had the best on-time performance with a 98% success rate. This included returns and exchanges from people doing a little holiday shopping for themselves. UPS and FedEx are now gearing up for that second wave of returns that begin today and continue into the new year. For Nightly Business Report, I'm Frank Holland.
And that next wave that Frank mentioned did start today. Eric Chemi has been tracking that action from Woodbridge, New Jersey.
While many people think the retail shopping season ends on the night before Christmas, millions of shoppers can't wait for the day after Christmas to buy everything on their wish list. December 26th is so popular, in fact, that ShopperTrack is projecting it to be the 8th biggest retail day of 2018. Three of the biggest reasons for post-Christmas shopping are big discounts, spending gift cards, and returning or exchanging unwanted presents. Taking advantage of discounts after Christmas is a textbook move for many savvy shoppers. Clearance sales abounded here at the Woodbridge Center Mall in Woodbridge, New Jersey.
My daughter got a lot of money and gift certificates, and we know that the day after Christmas is a great day to go shopping for sales.
Well, I'm just doing some Christmas shopping with my dad. Every year we come the day after. He just gives us some money and we splurge.
I had to return a coat, and I was dreading it because I thought the lines would be awful, but it's been great.
I'm here to spend some gift cards with the kids.
And for shoppers who received gift cards on Christmas Day, this is a great day to spend them off. But not everybody remembers to use those gift cards, letting them disappear in a closet or drawer. CEB Tower Group estimates $1 billion in value in unspent gift cards every single year. More laws around the country have removed gift card expiration dates, which can often take away the urgency to spend the money. Even though the stock market has taken a dive recently, many retail data points have shown recent strength from companies like UPS and Amazon. And just on Wednesday, MasterCard said this holiday season is the best it's been in 6 years. For Nightly Business Report, I'm Eric Chemi in Woodbridge, New Jersey.
Roku is crowned as a top pick at Needham, and that's where we begin tonight's market focus. Needham named the streaming device maker as a top pick for 2019 due to the company's revenue growth, margin expansion, pricing power, and overall strength in a growing market. The firm reiterated its buy rating on the stock with a $45 price target. Roku shares popped more than 11% in today's rally to $30.35. Last week, we told you the drug maker Perrigo was given a surprise tax bill just shy of $2 billion. That was an amount that Perrigo said it would appeal. Well, the news shaved off about 30% of the company's stock last week. Some of that was recovered today as the Friday deadline for Perrigo to repeal the decision gets closer. Shares rose 11.5% today to $40.70. Wedbush Securities said that it expects demand for Tesla's Model 3 vehicle to continue to rev higher. An analyst at the financial firm said that consumer interest surrounding the car will likely be strong next year and beyond. And that means it is less likely that the automaker will have to raise capital in the near term. And investors like that. They sent shares of Tesla higher by 10% today to $326.09. And Blue Apron and Weight Watchers, they're partnering now on meal kits for 2019. Blue Apron says that this partnership will mean it can stabilize and hopefully grow its subscriber base without spending as much money on advertising and promotions. Blue Apron shares jumped 14% to 79 cents a share. That's right, just 79 cents. Weight Watchers, meanwhile, rose about 5.5% today to $42.35. Well, for the first time in its 50-year history, IMAX has pulled in $1 billion worldwide at the box office. But the big screen theater chain owner also recently announced it is shutting down its virtual reality locations and writing off VR content investments. But it's still betting on virtual reality location-based entertainment centers to bring VR to the mainstream. And Julia Borston has more on that for us.
Virtual reality didn't take off the way many had hoped, as consumers proved reluctant to invest hundreds of dollars in headsets. Even IMAX is shuttering 7 virtual reality centers around the world. But that's not stopping the push to make virtual reality, or VR, mainstream and end up in a mall near you. According to one estimate, the category is expected to grow to $12 billion within 5 years. Dreamscape is opening locations in 5 cities around the country, including this one in Los Angeles. For For $20, visitors don a headset, backpack, and hand and feet sensors to enter one of 3 virtual worlds for a 20-minute experience.
We believe that location-based VR is the tip of the spear, as it were, for the entire VR industry. It will get people exposed to how unique this medium can be, and also those of us who create it, we're learning the capability as well.
Dreamscape is backed by theater chains AMC and IMAX, as well as Fox, Warner Brothers, Viacom, and MGM. The studios are strategic partners, looking to expand their brands into new dimensions, while the theater chains explore bringing these virtual experiences into the lobbies of cineplexes as they adapt to declining movie ticket sales. Dreamscape is part of a larger trend. Spaces, backed by Comcast Ventures, launched a multi-sensory Terminator Salvation VR attraction at one of Southern California's biggest malls. Disney invested through its incubator program in The Void, which will have 17 location-based VR destinations by year-end, all featuring a virtual Star Wars experience. Veteran Hollywood producer Walter Parks, behind hit franchises such as Men in Black, co-founded Dreamscape to take premium Hollywood content into a new format and to adapt to changes in the industry.
There are many reasons for people not to go to movies at normal theaters. The ability to stream things at home, how extraordinary the televisions and sound is. So they're very anxious not only to see VR succeed in and of itself, but also to create more energy around places like this that sort of support the communal aspect of film going.
But the jury is still out on whether consumers will want to spend hundreds of dollars on headsets or even $20 for an immersive experience at a mall. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Up next, portfolio tips from a financial planner as you ring in the new year. So as another year winds down, now may be a good time to start considering changes to your portfolio in the new year. And joining us tonight for a strategy session is Tony Drake. He's CEO of wealth management firm Drake & Associates. Tony, thanks for joining us tonight.
Great to be here, Bill.
First of all, can you blame anybody who may be a little hesitant to put money to work in a market like we're seeing these days?
Yeah, boy, the volatility has just been unbelievable. I mean, today we saw obviously incredible pop with the MasterCard data coming out, maybe the best shopping season in 6 years, but it's scary for your average folks at home investing and looking at their 401k balances.
Let's start broadly first. Next year, stocks versus bonds, who do you think performs better necessarily?
You know, we're definitely seeing a big move to the bond sector, although I still think there's some equity sectors that might look well. The financial sector with a couple interest rate rises, you know, the potential steepening of the yield curve could be really attractive, in particular high dividend paying financial sector items.
What about, and on the bond side, especially if we're talking about treasuries, shorter term bonds, longer term bonds, what do you think?
I really like the shorter term duration bonds. If you're buying them individually, there's some really attractive bond ETFs that are managed. Those managers are maintaining those shorter durations, pretty low internal costs there. That can be a great alternative to cash.
By the way, on the equity side, I noted that you like utilities for next year. If you like the financials because rates are going to go higher again next year, that's not good for utilities, is it?
No, there's certainly a couple different moves there, but utilities, if the volatility really continues at the level it had been, you know, those perform really nice in those economies that are just struggling along. There's some great utilities out there that have, again, some great dividends, help offset some of the short-term volatility on the equity side.
Real estate. We've had a slowing of the housing market here, but yet real estate investment trusts have still done well. Is that a good place for income still? What do you think for 2019?
Yeah, the REITs can be a great place if you don't need liquidity. They pay out some nice dividends. You know, if you're looking for short-term investment in residential real estate, I think that slowing that we're seeing could turn to negative next year and could really cause some problems. Homes are a great thing to buy if you're buying for the long term, but short-term investment, I'd stay away from residential real estate.
Cash. Plenty of money managers lately have been saying, because of the volatility, because of the declines we've seen in the market that maybe cash is a more attractive investment vehicle. What do you do with that cash? Where do you stash that in the meantime?
You know, it's really about having that plan and what stage you're at in the investment planning, if you're close to retirement, in retirement. But we're seeing some rising rates in mutual funds, money market mutual funds. Again, those short-term duration bonds can be a great alternative. Interesting, we're seeing some data out of some economists with fixed indexed annuities as an alternative to cash long-term. So there's a couple great options there, but you always want to, when you jump out and panic, you know, with this volatility, I think it's easy to panic for folks. And, you know, imagine you're in an airplane, you're feeling a lot of volatility. You don't head for the exit. You got to write it out. You need to have a plan. Cash might be part of that plan, but make sure it's an overall picture.
And quickly, before we go, gold, do you like it? I mean, it's usually talked about as a perennial percentage in a portfolio of some kind, but if inflation is going to start to rise, what do you think about gold?
You know, gold is a tricky area. Obviously, we can see some volatility in the metals as well. I like it as an alternative for a small portion of the portfolio, but I think there's some better opportunities for cash in your portfolios nowadays.
All right. And you think we see volatility continue in 2019? He asked naively.
You know, yeah, I mean, how could we not almost? I mean, I think the chances of 3% GDP and 25% earnings is just tough to maintain. And as that reduces, you know, the benefits from the tax cuts and, you know, the fear over the tariffs, it's tough. Companies need to know 10%, 25, what's it going to be? They need certainty.
Tony Drake with Drake & Associates. Thanks for joining us tonight. Appreciate it.
Thanks, Bill.
Before we go, a final look at a record day on Wall Street. Biggest one-day point gain ever for the industrial average. Almost a 6% gain for the NASDAQ. The S&P up 5%. What a day. That is it for the Nightly Business Report. Thanks for joining us, everybody. I'm Bill Griffith. Have a great evening. See you tomorrow.